Very good afternoon and welcome to our webinar for today called How to Invest in 2016. We have had a very high attendance and request for the webinar, so we have a full house and I'm excited about it. A bit of housekeeping. Any content, opinions, or anything expressed in today's webinar, please take it and it will only constitute of general advice. We do not know your personal circumstances, so Roger nor Chris can give you any personal advice in today's webinar. There will be a few tickers mentioned. Again, please note any data or anything that was brought up was correct as at the time the webinar was prepared. Let's get straight into it. As you may know, today we'll have Roger Montgomery, who is the founder of Skaffold, and he was also a founder of Montgomery Investment Management. He's going to share his strategy and approach as a fund manager, plus a few stocks for 2016. Now, I know we're all excited to hear those. And we also have Chris, who's the general manager and also founder of Skaffold. Now, he's going to share his strategy as a self-managed super fund investor, plus the themes that will drive growth. Now, if you're ready, I'll throw the first question to Roger. Hey, Roger, the very first question is, how do you build an investment strategy that can withstand volatility? We've seen a lot of it going on around this year. 2016, what do you do?
Look, what you do in 2016 is exactly the same as what you do elsewhere in terms of market cycles and also through the years. And the answer is really quite simple. We've got one answer to it, I should say, and it's not the only way to do it. But the way we do it is simply three things. One, we focus on quality. So it's imperative that we're buying businesses of the highest quality. Generally, that means companies with a high and forecast to be stable return on equity. So we're looking for businesses that have bright prospects for their return on equity. And we're also looking for businesses that quite simply have bright prospects for their products and services. The other thing that we do is we buy only when companies are cheap. Now that is one of the hardest things to do because we're looking for companies that are cheaper than their value, and that means that you have to be very patient. And the third thing that we do is we hold cash. So if we turn to the next slide, here's an example of a business that we don't think has very bright prospects. This is a DVD rental kiosk that is owned by a company in the United States called Outerwall. They have 43,000 of these Redbox DVD vending machines. And if you ask yourself the question, do I think people are going to be hiring more of their entertainment through a DVD vending machine or less? Clearly the answer is less. So this is an example of business that we don't think has bright prospects. The other thing that we do is we focus on businesses that, as I said earlier, have high and sustainable returns on equity, but also have the ability to retain large amounts of their profits and grow them at that high rate of return on equity. So here I've got three companies up. We've got M2 Telecommunications, Telstra and CSL. And what you'll notice is I want you to imagine for a moment you put $100,000, we'll just pick two of these, $100,000 into M2 Telecommunications and $100,000 into Telstra. Now one of the things that you'll notice is that the yield in 2005 on Telstra was 5.97%, which is a lot more attractive than M2 Telecommunications' yield of 3.91%. So on $100,000, Telstra was giving you income in 2005 of almost $6,000, whereas M2 was a couple of $1,000s behind that at $3,900. But there's a difference between these two companies. Under Sol Trujillo, Telstra was paying out about 100% or a little bit more than 100% of its earnings as a dividend, whereas M2 Telecommunications was retaining a lot of its profits and compounding at a very high rate of return on equity. Now, both companies had attractive returns on equity, but M2 was able to retain profits and compound that return on equity. So if you fast forward to 2015, the $100,000 invested in Telstra grew to $117,000 and your income of $5,970 grew to $6,500. You can see that at the bottom of the middle column there. But look at M2, the only difference, of course, being that the company was able to retain profits and grow the value of the business. And so $100,000 grew to $3 million, and that $3,900 of income has grown to $99,800 on an original $100,000 investment. So the point I'm trying to make here is that the businesses we're looking for are businesses that have high rates of return on equity, but also the ability to grow by retaining profits and compounding it. And you can see that on the next slide if you look at the difference between the growth in the dividend, which is the green line, and the subsequent share price performance. You can see that in the case of CSL, good growth in income because they've been able to retain and compound profits, and the share price has done phenomenally well. Have a look at the next example, which is M2 Telecommunications. Again, good growth in income because they've been able to retain and compound those profits, and subsequently very good share price returns. If you have a look at Telstra, over the same period of time, virtually no growth in income, and you can see the share price is lower than where it was back in 2000. And so it's important to look for growing income, not just high dividend yields, and that will certainly be the case in 2016. And of course, if you go to the next slide, you'll see that what we're trying to avoid are businesses that have terrible economics. So here's an example. Imagine for a moment, and I'll take you through these numbers now very quickly, but imagine for a moment that you owned this business and you asked me to run it for you. So you put in $393 million in 2004, and we go down to the bank. I'm going to run it for you. So we go down to the bank together and we borrow $500 million. You can see that in the first column, 2004. And after running it for a year, I report back to you a profit of $158 million. Now that's a return on the equity that you put in of about 40%. So obviously you're really delighted with that. You're very excited about that. So you let me run the business for another 10 years. You come back after 10 years and you say, Roger, how's the business you're running for me going? And I report now a loss of $353 million. Now, by the way, all of this has come from the capital history screen in Skaffold. So what Skaffold does is extracts the relevant information from 10 years of annual reports to show you the story of what it would feel like to own the whole business. So now imagine 10 years later, I'm reporting to you a loss of $353 million. The loss before that, the year before that, was a $100 million loss. Year before that was a profit of about $40 million, but the year before that was a loss of $66 million or thereabouts. So you're not happy anymore. What if I then told you, in addition to profits declining, that you've actually been putting more money into this business to grow it? So you've now put $1.1 billion or $1.147 billion into this business to expand its geographical reach, to expand the customers that you're servicing, to expand your plant, machinery and equipment that you're servicing those customers with. This is an unmitigated financial disaster. You would then probably ask me, well, Roger, I hope you've paid off the debt, the $500 million. Remember, we borrowed $500 million 10 years ago. Hopefully, at least we don't owe the banks any more money. Well, in fact, you owe the banks $2.5 billion now. So this is an unmitigated financial disaster. And the number that is being produced now is a return on equity of minus 30%, but more importantly is the next column, the change. And what you can see there is that the capital has gone up by, the equity you put in has gone up by $554 million, but the profits have declined by $500 million. So that means every dollar you've put in the business in the subsequent 10 years has lost 67 cents. You do not want to own a business like that. So we can avoid those businesses by simply avoiding the C-rated companies in Skaffold and companies with performance scores of 4 or 5. And you'll find that Virgin Australia Holdings, which is what this business is, has a very low quality rating on Skaffold. More importantly, though, if we change the slide again, you can see there's a good relationship between the share price and the economic performances described in Skaffold's capital history screen. So you can see here 10 years ago, the share price of Virgin Australia Holdings was about $2.50 or thereabouts, and now it's closer to 40 cents. And that's true because in the long run, the market is a weighing machine. In the short run, it's a voting machine, as Benjamin Graham described, but he also said in the long run, it's a weighing machine. So it's very important not to be in the market. You know the phrase, invest for the long term. Everyone tells you invest for the long term. Well, that's only true. That's only true. Time in the market is a good thing when you're in good quality businesses. You need to avoid the poor quality businesses. So this quote here from Warren Buffett now makes a lot of sense. Time is the friend of a wonderful business, but the enemy of the mediocre business. The longer you're invested in a poor business, the worse it's going to get. And let me tell you what inspired the capital history screen in Skaffold. It was literally a quote from Warren Buffett, where he said, if you're not prepared to own the whole business for 10 years, don't own a little piece of it for 10 minutes. In other words, what he was saying was, if it wouldn't feel good to own the whole thing for a decade, it's not going to feel good to own the shares, and you shouldn't buy the shares. And so the capital history screen is there to inform you about the businesses to avoid. So in 2016, I'm going to give you a list of some other surprising businesses that have similar share price performances over 10 years. So if you have a look at BHP, you can see since 2006 the share price is unchanged. In fact, the share price is now about $22, so the shares are back to where they were in 2005. So 10 years of no positive share price performance from BHP. Same thing from Rio Tinto there. You can see no improvement in the share price over 10 years. CIMIC, which is the old Leighton's Holdings, again, share price back where it was in 2007. National Australia Bank might surprise a few people. Share price back where it was, we're talking 16 years ago. No share price improvements. This is a so-called blue chip company. And the only way the share price could have done nothing over 10 years is if the value has done nothing. And the only way you can destroy value is by not generating an attractive return on your retained profits. And that's certainly been the case over at National Australia Bank. And the capital history screen will show you that on Skaffold. Here's another one, Telstra Corporation, share price lower than where it was back in 1999. So 16 years and no positive return. And that's because Telstra's profit is precisely where it was 10 or 12 years ago. AMP, another one, lower share price performance, going back a very long time, about 16 years. And our final example, Boral, you can see despite all the excitement about a recovery in construction in the United States and the building boom going on in Australia, yes, the share price has gone up since 2012, but if you go back further, the share price is unchanged since about 2004 or 2005. Now, all of these companies have been variously described as blue chip companies, but I reckon that's the only blue chip that we're looking at in that suite of companies. And fortunately, and this is what makes Skaffold such a useful tool, it's going to help you filter out those companies. Some of you listening today and watching this presentation are going to be thinking about some of those blue chip companies as an opportunity for gains in 2016. But the way I think about it is I'm less interested about owning poor quality businesses and more interested in owning high quality businesses irrespective of what's going to happen next year.
Wow, that's very mind-blowing, Roger. Now, Chris, I want to bring this closer to home and bring into the discussion. Roger's brought up some very interesting tickers, some that we know are very darlings to people's hearts. Now, can you apply the same strategy and can you look at things the same for your self-managed super fund?
Yes, certainly, Shepard. You can certainly do that. One of the keys to running a self-managed super fund, as Roger has rightly highlighted, you need to focus on quality stocks. And in order to do that, you need, you either need an enormous amount of time to do the research yourself, or you need a tool that's going to help you do that. What we look to focus on here at Skaffold is a tool that helps you filter out some of those not so attractive stocks quickly and easily, and so you can then drill down and focus on the ones that really are worth looking at. So, Shepard, you asked the question at the start, what do you do to withstand volatility? And I wanted to bring the perspective of, say, a retail investor, someone with just a small amount of money to invest. And a key thing is to focus on diversification. What I do when I'm running my own self-managed super fund is I really do try and stay diversified, and I do that across a number of different ways. Firstly, I look, of course, at the type of business, the industry that it's in. I also look at the size of the business, so I don't want to have my whole portfolio in small caps, nor do I want to have the whole portfolio in large caps. So I try and spread it across different size businesses. I also even spread a little bit across investment style. So I'll have a little bit of income, a little bit of growth, and primarily I'm focused on value investing style. And lastly, geography. I have the majority of my portfolio in Australia, probably 70%, but I've also got investments in the United States and the UK, and I've used Skaffold to help me source the appropriate stocks there to invest in. For most of us, we're kidding ourselves if we think that we can do that. You know, many of us have careers and family life and so on, and so we don't have the time just to go into that much detail. The thing about diversification, of course, it reduces the risk of something unexpected happening, which will have a detrimental effect on your portfolio. But also what people sometimes forget is it increases your chance of catching a winner. If you're invested narrowly in just a handful of stocks, and the one that you were thinking about investing in but didn't is the one that does really well, well, you've missed out on that opportunity, and that might have been the one that really made your portfolio.
All right, Chris. So what rules do you apply when you go through the strategy?
Okay, so things that I like to do, I like to have a very systematic approach. So I focus on rebalancing my portfolio at least annually. Often it's more frequent than that, usually just after reporting season, so half annually. I also aim to be equally weighted across the stocks in my portfolio. And if I get a stock that does really well and is therefore growing in terms of its position in my portfolio, becoming what they call overweight, then I'll trim that exposure or I'll sell some of that stock. And a very pertinent example is just earlier this week I sold some of my Certex shares because Certex has done really well and was starting to become a significant chunk in my portfolio, and so I sold some.
In 2 minutes, we're just going to spend the next 8 or so minutes just giving what I would like to call 2 minutes pearls of wisdom. And I suppose in your context as a fund manager, Roger, just tell us, do you need diversification if you're buying the top stocks? Because we talk about A1, A2, B1, B2 stocks, which are good quality stocks. Now, if I'm investing in good quality stocks, do I need diversification or what's the go there?
As a minority shareholder and a passive shareholder, you don't have control of the business that you're invested in. And I can tell you this from painful personal experience. There was a stock many years ago that I bought called for our clients called the Reject Shop, and we bought that at just after it floated at $2.40. The share price subsequently went to $17 or thereabouts, and I can remember on behalf of clients that position grew to about 44% of the entire portfolio. Now, through sort of a sense of desperation, we managed to reduce the size of that position in the portfolios at the time, but the share price still subsequently collapsed when a new CEO came in and didn't do such a great job of running the business. Retailers tend to require merchants running their business, and this particular individual was a corporate animal rather than a merchant, and so the share price subsequently fell dramatically. Now, it's good that we took some profits, but from that experience, I've learnt that there are things that can happen that are outside the control of even the very best analyst. To remember, you're an analyst, you're not a business manager, you're not running the business. And for that reason, it's very important to diversify. So we can have 10 or 7 or 10% of the portfolio in an individual stock, but we never have. And the most we would ever get to is about 6%, and many of our positions are 3 or 4% of the portfolio. That means that we need to follow more companies, but by the same token, it means that if any particular event outside of our control occurs that is adverse, it's not going to have a permanent disruption to the growth of our capital.
Okay, thanks. Now, Chris, let's just focus on self-managed super funds. And again, with that same thing in mind of 2-minute pearls of wisdom, how much, what is the ideal number of stocks to have in your portfolio? Let's start off with that. Say I've got 20,000, 50,000, 100. What's the ideal number?
Yeah, ideally we would say let's focus on 15 to 20 stocks, but what's important to consider when you're looking at that, Shepard, is balancing your transaction costs against the number of stocks. So if you've only got a fairly small portfolio, say $20,000, you might only want to invest in 10 stocks. That would give you an exposure of yeah, $2,000 each, which is probably about the smallest size position you would want to have. The other thing, though, it's important to look at the correlation between your stocks. And by that, I don't mean some convoluted mathematical thing. What I mean is just look at the businesses in your portfolio. If you've got, say you've only got 5 stocks, but 4 of them are the banks, well, you're not really diversified at all. But if you've got 5 completely different stocks, well, then you're starting to get a measure of diversification into the portfolio. So I think it's really important, and I touched on this in my opening comments, that diversify across a number of different metrics, be it the size of the business, the industry of the business, and the geography, of course, of the business. You look to really spread your risk by focusing on how the businesses in your portfolio are different and won't be, if there's a particular adverse economic event, it won't impact all of those businesses in exactly the same way.
Can I just chime in there with Chris's comments? We limit our exposure to individual sectors to 20%. So even though an individual company can have a maximum position size, we also have maximum position sizes in sectors. For example, financials or retail, and that helps to mitigate some of the risks associated with adverse macroeconomic impacts on individual sectors.
Yeah, what I might just do, just to go into that concept a little bit further, Roger, is I guess people might be interested to see, this is my actual portfolio, so I'm putting myself out there for a minute. And what you can see there is that little pie chart shows you how my portfolio is diversified across the different sectors. You can see, this is by no means the ideal portfolio, but it's done all right. We're up 29% over the last 12 months, or 142% since inception. What I wanted to highlight here is these little sectors here. You can see that the red means it's gone down in the last day, and the green means it's gone up. But what I can also do, I can click on this little button here, and that'll take me to a list of these stocks that are in my portfolio. And then what I can do is I can edit the columns, and I can pull up the sector, and I can indeed go one step further and pull up the industry, save those columns. And so what you can see here is, if I just sort by sector, whilst there were 4 businesses in the services sector, if you look at them, one's personal services, it's Flight Centre, it's a travel agent. One's schools, 3P Learning, they provide educational software. One is advertising, REA Group, the realestate.com, and one is retail, Nick Scali, making furniture. So whilst at the very top level they may look quite similar, all being in services, they're actually all very different businesses. So that gives you a bit of an idea, if you look down that industry column, of how I've chosen to diversify my portfolio.
In a minute or so, what is your main challenge of running a self-managed super fund?
Well, the challenge, as always, Shepard, is how to make money. But that aside, it's all about how to manage your time in the midst of a busy life, and that's why you really do need a tool like Skaffold, and you need a systematic process. Nothing beats having a systematic process that you can follow through and just have some rules. It makes decisions for you ahead of time.
Okay, and very quickly, Chris, we asked you before how long you hold shares for. Can you just run us through that?
Yeah, sure, Shepard. The answer to that is that I hold them for as long as they remain an appropriate investment. Now, I know that sounds vague. The answer is, the longer the better as a general rule, but never be wedded to a particular stock. It's important when circumstances change to be willing to change your investment. And I'll just give a couple of quick examples, if you like. Again, harking back to my own SMSF. Just recently, I sold ANZ. Now, the reason for that was it shifted from an A2 to an A4 stock. So if I just pull up ANZ, you can see
I'll go to
And
the
I'll go to the
Skaffold small
Skaffold
screen.
small screen.
You can
You
see
can
there
see
that
there that
it
it
changed
changed from an
from
A4
an
to an A,
sorry,
from an A2 to an A4. So that was a reason to sell. Another reason to sell might be that the investment has done exceedingly well, which is obviously is the best reason, and you now believe that the value of that business the price of that business far exceeds the value. So if I pull up Flight Centre here, you can see back here, about here it was, in November 2013, I sold my Flight Centre stock because I sold it around $52, and then I subsequently bought it again about here. I can't quite get my mouse on it, but yeah, here at around about $39. Now, unfortunately, I didn't quite pick the bottom, but that's life. But you can see the logical reason there was that it was now trading at a discount to its intrinsic value. And I guess the third and final reason for now, Shepard, is that sometimes just a better opportunity presents itself. So earlier in the year, I held Macmillan Shakespeare, and I'll just load that up into this compare function, and I decided to sell Macmillan Shakespeare, not because I hated it, but simply because Nick Scali was a better opportunity. And you can see on this summary screen that, you know, Macmillan Shakespeare is not terrible, but Mick Scali's got a lot of better attributes. And likewise here, Macmillan Shakespeare fell away to an A4, whereas Nick Scali is an A1. It's only been a short while, but the nice thing is that Macmillan Shakespeare's fallen about 13% since I sold it, whereas Nick Scali's up 20%. So it turns out that was a good choice, at least in the short term. And of course, to keep tabs on all of that, I use Skaffold's alerting function, the daily email alerts, so as I don't have to spend a lot of time looking into it.
All right, great. Thanks, Chris. Now, gentlemen, let's look forward. Let's look into 2016, and I want to start off with you, Roger. What themes are going to kick us off next year?
Okay, thanks, Shepard. Well, the first thing is it'll be a mistake to focus on yields. So it's absolutely vital that the apparent attraction of the yields in the banks after the sell-off doesn't lure people into what we call a value trap, and that's where they believe something is cheap but the shares could fall further. And it's important that you buy high quality business, which for example, the Commonwealth Bank and Westpac particularly are very high quality businesses. But we also need to buy businesses with bright prospects. And there were two recommendations that were set down by David Murray's Financial System Inquiry. Recommendation one was that the banks increase their Tier 1 capital, what's called their Set 1 capital or Common Equity Tier 1 capital, to a level that made them unquestionably strong. And the second recommendation was that they increase their mortgage risk weighting ratios. And that was in order to level the playing field with some of the regional banks. Now, the impact of these two things, when you lift capital and you reduce the amount you can leverage that capital through the mortgage risk weighting ratios. In other words, I should just take a step back. When in recommendation 2, what that meant was that for every dollar of capital that the banks had, they couldn't lend as much to mortgages. So their ability to leverage their capital, even though they had more capital, they needed more capital and they couldn't leverage it as much. So that reduces the return on equity for the banks. And the other thing that we noticed was that if you go back and you have a look at the profit growth of the banks in the bottom section of this table here between 2011 and 2015, the reason why I chose 2011 is because I didn't want to look at the share price appreciation from the depths of the GFC, which was 2009, March 2009. So I wanted to cut that rally out and just have a look at what happened to share prices between 2011 and 2015. And what we saw was that there was a 30% increase in the profits in aggregate of the big four banks, but a 73% increase in the share prices. So the share prices got well ahead of themselves and the banks were expensive. So that meant they're expensive. Now they look cheaper, and they definitely are cheaper. There's no doubt about that. But the risk, of course, is that their return on equity is going down or going to be flat. So their prospects aren't as attractive as they were. And I think what we'll find is that a lot of the analysts will start to lowers some of their forecasts for bank profits in the future. So investors have looked for yields in banks. There's also, and there's risk there now. They've also looked for yields in property. And the big danger there, of course, is that the banks have capped how much they're lending on investor loans. They've also increased their interest rates on investor loans. ASIC, in addition to this, and it's not on the slide, but in addition to this, ASIC investigated 140, they just took 140 interest-only loans and assessed them for risk. And what they found was that banks were not responsibly lending. They weren't giving borrowers the information that they required to make a proper assessment of the risk. They were overestimating how much time borrowers had to pay back their mortgages after the no interest period or the zero interest rate period expired, the interest only period expired. There's a big risk that we're going to see property prices not go up. Demand for property will go down because the cost of borrowing money has gone up, and that will ultimately shoot the banks in the foot in terms of their prospects for growth. So their capital has gone up, that reduces return on equity. Their growth rates are going to slow slightly, that's going to reduce their return on equity, and that changes their prospects for valuation increases, and so that changes the prospects for their share price increases. What about the macro picture? Well, Australia is very much, and I was quoted in the Australian newspaper the other day saying Australia is in a fetal position with its fingers crossed. And what I mean by that is, there's a lot of thumb sucking going on about what our prospects look like, and they're very much tied to this graph. This is fixed asset investment and gross fixed capital formation in China. And what you can see is this is what's driven our demand for iron ore and coal, China's demand for our iron ore and coal, and you can see it's falling in a heap as of 2014. It's even lower than that now in 2015. And what's important to take away from this is that the property sector in China demands or uses about 25% is 25% of fixed asset formation, and that's a big consumer of steel, and that's declining. And in fact, in residential real estate in China, there's about 10.8 months of excess inventory. So we've got almost a year of inventory in China. Everywhere else in the world where there's been a year or 2 or 3 years of inventory, property prices have fallen. Commercial real estate in China has already fallen 50%. In terms of price, it's halved, and they had 3 years of excess supply of inventory. So residential real estate's fallen about 8% so far, and it's probably going to fall further. So demand for iron ore and coal is not going to increase anytime soon. Infrastructure, the development of roads and bridges and so forth, that's 22% of demand for fixed assets. And what's happened is local governments borrowed money from the People's Bank of China to develop these cities and roads and bridges and railways, and they're only getting about a 3% return on their assets. But the loans, the money that they borrowed from the People's Bank of China is being repaid at 7%. So they're losing money. There's no demand to build more infrastructure by the local governments. And that means, again, no reason to expect iron ore to increase. Now, I notice that Nev has written in a question, should I buy BHP? Why or why not? And Sandra's asked, would you take a loss on BHP to buy a better opportunity? I can't answer those questions directly, but I'm giving you a picture of BHP's outlook now. The iron ore price could drop considerably further from here. Manufacturing is 33% of demand, and it's slowing down dramatically. So it's very important to understand that the outlook for Australia is very much tied to China, and the outlook is not improving, not from China anyway. What does that mean for the Australian dollar? Well, here's a bloke that's taking a dive, and that's probably the best chart I can give you of the Australian dollar at the moment. Our view is that there might be a short-term bounce. GDP numbers might surprise on the upside. The next GDP number for Australia might be a little stronger than everyone expects, but longer term, we think the pressure is on the downside. And that's a good thing for domestic tourism. So the outlook for domestic tourism is probably good. The outlook for domestic retail is probably improving because buying things from overseas is not as cheap as it was with the Australian dollar going down. There's a few other stocks we're going to talk about for 2016 in just a moment. But having painted a very bleak picture for Australia, let me tell you, we're in the business of investing in individual businesses, as everyone listening is as well. And so we're looking for individual businesses with bright prospects. We're not going to sell all the stocks we own because we think the outlook for Australia is muted.
Great. Now, Chris, Roger touched on China. What's your take on that theme?
Yeah, okay, Shepard. Well, I'll extend what Roger was saying. I'm in total agreement. You know, obviously infrastructure and construction growth in China has completely fallen off a cliff. But the other side to that is domestic consumption by the middle class in China, and that has been growing. This quote here from President Barack Obama, where he said, China in particular should unleash its emerging middle class by accelerating its transition to a consumption-led economy. As President Xi Jinping has acknowledged, China's export and construction-driven growth is no longer sustainable. So that's the second part of that's what Roger talked about, and the first bit, which is not on the screen, but the first bit to that quote was about unleashing the middle class to a consumption-led economy. What we're seeing in China is now the service industries make up half of China's economy. And we're seeing a growing appetite amongst that now considerably large middle class for consumer goods, for travel, for cars in particular. We're also seeing online retailing really booming in China. And things like Tmall Global or JD.com, these are websites in China which are kind of like the eBay in China. And they are turning over astonishing amounts of revenue, of transactions, and this actually presents opportunities for Australian companies because Australian companies can sell into China using those particular platforms. And on that same note, the free trade agreement, which was signed in June of this year and is in the process now of being implemented, is also opening up opportunities within for Australian companies to sell into China, things like wine, vitamins, health food, the very topical baby formula who have young children, agricultural and food products. There's opportunities for these businesses within China. So, you know, the upside, if you like, to the China equation is this growing middle class. Shepard, I guess that where that leads us to is, well, what in particular, what sectors and what stocks are going to be impacted by the by some of these trends that Roger and myself have identified? And we've both already alluded to, with the falling Australian dollar, China's growing middle class. Some of the sectors that you might want to look at are education and also inbound tourism. If you can just pull up that chart, Shepard. This shows how overseas visitors to Australia have been steadily growing. That's over, 30 years, and you can see a good, strong growth rate in arrivals in Australia. And if we go to the next chart, it shows the percentage of those people that are coming from China, and we can see that China is really accounting for a growing percentage of inbound tourism. We're seeing that, just here in our offices. We're just opposite the Sydney's fish markets, and we see busloads of Chinese tourists arriving every day. I've had a friend who's here from China, and they wanted to get on a tour, sightseeing tour, and all the Chinese-speaking sightseeing tours are booked out. There's a lot of demand in that particular area.
Now, gentlemen, I just want to speed things up again, and just to reiterate, Roger just gave us a brief his brief view on the theme of Great Southern yields and the Aussie falling dollar, which led us into Chris explaining obviously the move and change in terms of the middle class of China growing. Now, let's talk stocks, gentlemen. Roger, we'll start off with you. Can you just give me, you don't have to go in depth, just 3 stocks you think will capitalize on these themes for next year?
Sure. Well, a big one obviously is Challenger. It's benefiting from the aging baby boomers, and what we like about this particular company is that it's enjoying growth on growth on growth. Now, when you compound growth, you get exponential increases in the value of a business. So this business is benefiting by selling annuities to aging baby boomers or retiring baby boomers. Now, we've got more people retiring. We've got baby boomers getting older, obviously. Within that cohort, more people are moving from the accumulation phase of their superannuation to what we call the pension phase. So that's growth on growth, because annuities are about income in pension in retirement. And then within that pension cohort, currently annuities represent about 4% of portfolios. If that moves to 6% or 7% or 10%, then you'll get exponential growth in the value of the business. And what's interesting, in the Financial System Inquiry by David Murray, proposed mandating a percentage of superannuation portfolios being in annuities, and Challenger is obviously, pardon me, going to benefit from that. And you can see the numbers for 2015 over on the right-hand side here. Assets under management in their fund business, now $60 billion, up 18%, normalised profit up 13%, full-year dividends up 15%. So this is a business that's going to enjoy growth for quite some time. I don't know what the share price is going to do. The question that's often asked of me, Roger, is in Skaffold, Challenger gets, I think, a C rating, and that's because it's got very high levels of debt. But when we look into that debt in more detail, what we find is the debt is matched by assets. And where the debt is matched by assets, and it's financial debt and financial assets, then really we separate that debt out. If we take that debt out, we give Challenger a higher than C rating. So that's why we're interested in Challenger. And the other business that we really think is going to surprise people on the upside is realestate.com.au. And the reason why is, while we also think that property is peaking and it could actually have a correction next year or the year after, coming out of the overdevelopment of apartments, what we know is in the boom that we've just witnessed, people weren't all listing their properties on realestate.com.au. Houses were selling so quickly that they didn't even need to be listed. And when they're not listed, realestate.com.au doesn't get a fee. But the more properties that are listed, and the longer they're listed for, the more money realestate.com.au makes. And so the REA Group is going to benefit, because as there's more competition to sell properties because the market's not booming, then what we'll find is more customers will take out premier ads, which cost more, and they'll be on the realestate.com.au website for longer. And if they're on for longer, the company makes more money. That's precisely what we're seeing in their quarterly updates.
Okay, let's go global, Roger. Do you have any from outside the ASX?
Yeah, look, I think Apple is a company that's going to do very, very well, and I know it's a business everyone's heard of, and that's probably why it was available cheap, because they sort of thought ho hum. Really, what's happening though is that China is slowing down. More and more of Apple's growth is coming from China, and because China's slowing down, people think it's going to impact Apple adversely. But what they don't realise is that even though the Chinese economy is slowing, smartphone growth is at 5%, but Apple iPhone growth is 87% in China. So that's in an economy that's slowing down. So what an Apple iPhone is affordable luxury for the Chinese people, and so while they're cracking down on spending on Prada handbags and Rolls Royces and Bentleys, they're spending up on iPhones, and it's an affordable luxury item. And as 4G penetration in China is only 12% or 11% at the moment. So as 4G spreads, you'll find more people buying iPhones. And we also know that Apple has just launched a new program for iPhone owners where you pay $32 a month and you can upgrade to the newest iPhone at any time and keep spending $32 a month. Just hand your old iPhone in and you'll get a new iPhone. So that's going to increase the upgrade cycle. Only about 25% of iPhone users have upgraded to the iPhone 6. That'll increase the upgrade cycle or speed up the upgrade cycle, and it also gives Apple control of the old stock, which they can then destroy rather than see on the market, forcing more people to buy a new iPhone rather than a second-hand iPhone.
Wow, that's good. Chris, so what are your three stocks?
Sure, Shepard. So the ones I picked were initially Breville Group. So Breville Group is a consumer discretionary stock here in Australia. They retail electrical appliances. And the reason I chose that one was simply that, both Roger and I have alluded to it, that the Australian economy is shifting away from the whole dependence on resource and construction, and shifting towards more being driven by the consumer. And the Australian economy has turned around a bit of late, it certainly hasn't shot the lights out or anything, but we have seen improving job numbers and some general, positives in the Australian economy. Also, a company like Breville actually makes far more of its revenue from overseas than it makes from within Australia, and that's being assisted greatly by the low level of the Australian dollar at the moment. On education, Navitas. Navitas is a company that provides courses for foreign students, so particularly English language courses, and some courses for local students as well, but it derives the bulk of its revenue by helping students from foreign lands brush up on their English and prepare for university courses here in Australia. So that will obviously benefit from the trend where a considerable amount of not just Chinese, but indeed Asian people coming into sort of middle class and are able to therefore invest not just in the essentials of life, but in things like education and the other one being travel. So inbound tourism, I chose AHD or Amalgamated Holdings. They're a company that have sort of two sides to their business. One is sort of the hotel side and the cinemas. So they're deriving a lot of their revenue from that inbound tourism sector.
I just wanted Roger to answer a few questions, and Chris as well, that have come from our members. Roger, do you want to take the first one?
Yeah, let's go through them pretty quickly. So Steve asked us, he asked specifically, where can he get affordable industry analysis? He finds IBIS is too expensive. Well, we actually subscribe to a consulting firm, which is even more expensive than IBIS, but you can subscribe to McKinsey's free newsletters. So McKinsey's is a management consulting firm. They send out free newsletters by email, and they cover various sectors, so that could be useful. Pam from Money Magazine. Hello, Pam. Nice to know that you're on the line there and watching the presentation. Pam asks, which Big Four banks should I own? Well, at the moment we own the Commonwealth Bank and Westpac. Ian asks about the supermarket battle. Can Woolworths and Coles withstand Aldi and Costco? In fact, Lidl is about to join. Our short answer to that is no. We sold out of Woolworths back in November. And the reason for doing that is we were fortunate to have a couple of hours with Paul Foley, who was the CEO of Aldi in the UK for 23 years, and we know the strategy and what they're going to do in Australia. And nowhere in the world has the incumbent supermarket been able to respond profitably or able to maintain margins when Aldi has entered their country, except for France. And I think that's because the French don't like the Germans. But elsewhere in the world, there's been no response. So we don't think Woolworths is a blue chip company anymore. I'll answer one more. Frank asks, IFM, will it survive and prosper? I do think, Frank, it'll survive. IFM Infomedia will survive. Whether it prospers or not depends on whether the current management's new articulated strategy works. And we're a holder of those shares, and we're going to have to take a wait and see approach to see whether or not it does in fact improve. So let's wait and see. So there's five questions answered in short order.
All right, awesome. Now, gentlemen, for the last 5 minutes, I just wanted to ask all of our attendees to vote for one stock that you guys can just get into more detail and drill down into in terms of 2016. Which stock you would like Roger and Chris to quickly go through? REA Group Limited, Breville Group Limited, Navitas, Amalgamated, or Apple. So everyone has voted, and these are the results we've got. So we've got REA Group leading the charts with 25%, and very close is Navitas and Amalgamated. But we'll start off with you, Chris. Can you just give us a quick spill on REA, and then Roger will close off the webinar with that.
So let's just pull up REA and have a look at it. Now, REA, as I'm sure many people would agree, is a very attractive business. You can see here, looking at the summary of REA in Skaffold, that it's a high quality business. It's an A2 business. Importantly, that middle bar, the historical change in value, very strong at almost 50%. So that tells you that over time this business has performed very well, and indeed it's forecast to continue performing very well. Now, it's trading at pretty much what we would call fair value, or its intrinsic value at the moment. And if we just quickly go through the screens here, And Roger, feel free to jump in as we go along. We can sort of tic-tac on this.
Okay, no problem.
The earnings screen here, you can see going right back, there's a very strong trajectory of earnings going up, and indeed into the future they're forecast to remain.
The only thing I will add is, the share price may not follow the earnings up. Our hope is that the share price actually reacts negatively to any correction in the property market, and that would present this company as cheap. And if that happens, we would be interested in buying more because we think it's going to surprise on the upside in terms of earnings and performance.
Yeah, well, I certainly hope you're right. Those of you who looked keenly at my SMSF would have noted that it was in there, and fortunately in there at about a 20% discount to what it's currently trading. So the capital history screen, again, we can see here strong equity. This blue line represents the return on equity, and that's sitting in the high 30s, close to 40%, and the red bars represent debt, and there is no debt. So very secure balance sheet and generating great returns on equity. If we go through the Skaffold score, consistently A1, dropped to A2 in this most recent period, but that's not really anything to be of great concern. And finally, looking at the value versus price chart, you can see, and as Roger has just alluded to, if it's trading at about fair value. If it was to dip due to a reaction to some, a negative perception around earnings, then that could indeed present a great opportunity to get into this stock at a lower price.
All right, great. Well, look, we are almost out of time. What I'll just quickly end of the webinar is just to remind everyone you do have one-on-one training. If you guys want to give us a call, you can call us. And for those of you that are new members, you can join Skaffold. You still have your 30-day money-back guarantee. And look, we might just take one or two more questions. You guys can pick any question.
Yeah, I'm happy. Look, there's so many questions coming in. I just think let's take the opportunity. Deborah asked why we're less positive on Qualcomm. There's been an antitrust case, an anti-monopoly power case in China against Qualcomm, and the courts in China found in favour of the customers of Qualcomm. And so what it means is there's some delayed payments by customers back to Qualcomm for the use of their chips, and we're just not sure whether or not that's going to be a net negative or positive for Qualcomm. So that answers that one. Saeed asked ROE versus return on capital. Why does Skaffold use return on equity? Well, we tend to look for companies with little or no debt. And when a company has no debt, your return on capital and your return on equity are basically equal. So we use return on equity because that's the right one to use for a company with little or no debt. And CabCharge, Deepak asks, CabCharge, what are its prospects? Well, the jury's out on that one, and we're not willing to take a risk on it because of Uber and the changes to the outlook. So you've got Uber impacting or fragmenting the market for CabCharge, and you've also got government coming in and restricting the amount that the company can charge as a service fee for the use of the CabCharge card service. And so there are reasons for not being as positive on CabCharge as we were many years ago.
All right, look, unfortunately we are out of time. Thank you very much for joining us today. Thank you very much, Roger, and thank you very much, Chris.
It's a pleasure.
And see you guys next time.
Investing in shares can be rewarding when you do your research, but it can also take up a lot of your time. With so much information out there, how do you quickly sort through the companies worth investing in and those to steer clear of? Skaffold is my research tool of choice. It tracks and reports on all ASX listed companies, plus thousands of global stocks daily, helping me decide which stocks to buy and sell. I can quickly filter through the reports to get the information I need. The rating system is like a set of traffic lights for the stock market. Green is good, orange is caution, and red is don't go any further. Skaffold's top stock choices have been highlighted for their outstanding performance by Money Magazine. With Skaffold doing the work for me, I have the confidence to make investment decisions without having to spend hours sifting through financial data. Now you can take control of your time and your portfolio. Why not take Skaffold for a test drive today?